everyone, good evening. It's 5 p.m. on the clock. We are kickstarting Rise with India Prime Time with me, Mubina Kapasi, and this is the Money Show, your one-stop destination for all your money matters, be it investing or even spending your money wisely. Here's what we have today on the show. First up, there is going to be a bit of easiness when it comes to the prosecution norms that tax defaulters may face. So whether you've underreported your income or you've not deposited your TDS, you could see ease of prosecution norms. Also, faceless income tax scrutiny is now a reality, which means you do not need to make those trips to the Aikar Bhavan to sort of face the income tax officer and explain your case. It is all going to go online. So we are going to give you a sneak peek into the processes right here on the first segment of Money Show. Also, we are going to be reviewing the second term plan launched by LIC in a matter of 1 month, and that is the LIC Tech term plan. We'll be comparing it with earlier plan as well, the Jeevan Amar plan, to understand what's the difference. And finally, here is Sarah Newcomb, behavioral analyst specialist of Morningstar, and she is going to let you in on some of the personal finance biases that you may be having that may not allow you to completely unveil your full money-making potential. So it's a busy day today on the Money Show. First, let's give you a glimpse into the big headlines at this hour. Oil pulls back after clocking its biggest single-day surge ever. Analysts fear Saudi Aramco may take weeks or even months before majority of the output is restored at its plant. Meanwhile, Russia warns against hasty reaction to the drone strikes amid escalated US-Iran tensions. Oil Minister Dharmendra Pradhan assures of no supply crunch post the Saudi drone attack, but admits that the oil spike is a matter of concern for India. He remains confident of an oil import deal with Russia's Rosneft. MMTC confirms that the firm has been asked to shut down unviable operations. Speaking exclusively to ET Now, management says the actual closure is going to take place post a valuation exercise. Also says STC and PEC are likely to see a shutdown soon. The government is working overtime to meet its divestment target. Sources say a complete exit from Hindustan Copper via a strategic stake sale may be a possibility. Niti Aayog also favors a complete stake sale by ITDC in Delhi's Ashoka Hotel. That's an ET Now exclusive. The government favors a single rate for lotteries under GST. The move is aimed at curbing revenue leakage. But Kerala is not on board for reducing the rate on state-authorized lottery. The matter may be taken up at the upcoming GST meeting. Well, that's the big news headlines that we are tracking for you this evening on ET Now. But back to the Money Show, and like I promised, today we are going to be taking up the topic of taxation. There have been a whole host of new rules that have come by, and most of them are, of course, to make your life easier as a taxpayer. This time around, with FM Nirmala Sitharaman as well asking the Income Tax Department to go easy on honest taxpayers, it looks like there is going to be an ease in prosecution norms of tax defaulters. Definitely not no prosecution, but ease in prosecution norms of tax defaulters. So whether you've underreported your income, whether you have misreported your income, whether you've got the TDS but not deposited with the government. Earlier, there used to be rigorous imprisonment, but now it's going to be taken on a case-to-case basis. And if the amount is under 25 lakh rupees, you could breathe a little easy. But yes, of course, the intent will be very important. Also, The other case is with respect to faceless scrutiny. Earlier, when you would get a case from the income tax department, or rather a notice from the income tax department, you'd have to go over to the income tax office, submit all those papers, documents, and your case proceeding would go on and on. But now everything is moving online. There is going to be a situation where you will not even know who the income tax officer is. That's the whole advantage of going online. It's an absolutely transparent process. And yes, now FM Sitharaman has made faceless income tax scrutiny a reality. So let's take both of these topics up now with Mr. Ved Jain. He is the former president of the Institute of Chartered Accountants of India. Mr. Jain, thank you for joining us on the Money Show. You know, Mrs. Sitharaman has been aiming and trying to make life easy for the honest taxpayer, and she's taken two steps, very important steps. The rules have just been notified. Let's start off first with the ease in prosecution norms. What are we looking at, and for which errors, if you could call it errors, since the intent is not to deceive the income tax department. So for which errors have the norms been eased, and by what extent?
See, so there has been a lot of discussion going on regarding the tax terrorism and the pressure being built on the industry, and to how to make the life of the businessman, the taxpayer, easier. So considering that fact, you will recall the Honorable Prime Minister made a call that the people who are wealth creator, wealth earners, they must be respected, and the country should be proud of that. So taking into consideration all these aspects, the Honorable Finance Minister has now come out with a two proposal, as you were pointing it out. One was those cases where the prosecutions have been launched in a cases where the tax default is not so big. As you rightly pointed out, there are new guidelines regarding the prosecutions, which is a very serious provision where one person can be imprisoned and one person can be sent to behind the bar. And there have been some technical defaults that the businessmen, when they make payment to the various contractors, professionals, or for the rent, etc., they are required to deduct tax at source of such person. And while deducting this tax at source, there are bound to be some technical problems, some delay or default here or there. So that prosecutions were being launched. So now the new guideline says that no prosecution will be launched where the default is of less than rupees 25 lakh rupees. I think which is a very welcome move. It will ease the pressure on the industry, which there was a lot of pressure because some technical default here or there. Moreover, there will be no prosecution for delay of up to 60 days in depositing the tax or TCS. So that's another welcome measure. Similarly, for late filing of return, etc., where the tax is 25 lakh rupees or less, normally in such cases there will be no prosecution unless the matter is examined by two senior officers of the department, and they feel that the person is habitually a defaulter or doesn't need any mercy. So in only those cases the prosecution will be launched. I think that's a good move. In addition thereto, in all cases where prosecutions have been launched earlier or pending, a window has been opened to them that they can get it compounded even now, irrespective of the period for which the prosecutions are going on. That's a very good move. I believe this is going to reduce a lot of pressure on the industry, and ease of doing business will be, I think, quite go up on that point. And the second point which you were mentioning about was the faceless assessment. I believe that's a big major change which has happened into the tax policy.
Mr. Jain, we'll
way
just
back
come
in
to
2004, the Income Tax Department has come out.
Mr. Jain, allow me to come in here. We'll come to faceless scrutiny. I just have a couple of follow-up questions when it comes to the prosecution norms. Now, one of the most serious offences is misreporting of income, right? I mean, especially underreporting of income in an attempt to sort of not pay taxation. Now, of course, as FM Sitharaman as well said, they want to differentiate between intent. So, an honest taxpayer should not be troubled. So, obviously, intent is something very difficult to establish. So, suppose if I am an assessee and my amount is under 25 lakh rupees that has been misreported as income, then it goes to a collegium, so on and so forth. But how will then the income tax officer sort of determine my intent, or whether or not it should go in for that extreme imprisonment of 3 months to 7 years, so on and so forth?
As on date, the income tax law is there that in case you have underreported the income, the tax is recovered from you, the interest is recovered from you, and, and then there is a 200% penalty which can be recovered from you. Now, what has been done is that in case underreporting of income is to the extent of tax effect of rupees 25 lakh, the government has a view that normally we will not launch a prosecution, we will not imprison such person. There are two reasons behind this. First, the amount is too small, considering that 25 lakh rupees, the amount is small, so that they feel that person should not be prosecuted. Tax, interest and penalty will take care of the default. Secondly, they have kept an option open that if such person is a habitual defaulter or the default is of such a category which they believe that this person should not get that benefit, then the matter will be referred to a collegium of the two senior officers who will decide that yes, this person does not need that concession, and then prosecution can be launched. So it is not an open window for all in the sense in which we understand. The idea is that in case that there is bound to be some technical default, you forget to report some interest here or there which you have earned on the interbank, you have some income which you have missed it out. So what was happening is that in all those cases there were or not tax, interest or penalty, but also the prosecution. So it has increased the workload not only of the officer but also of the courts in the prosecution, with the result that the people who have having made serious offences, they got out because of the workload and the pressure. Now with this, I think selective prosecution, the people who evade taxes and who are the hardened evaders, they will be taken care of, and the department will be able to persuade those cases more effectively. Now it will be a more qualitative prosecution rather than a quantitative prosecution, which is the whole objective of I believe of the deterrent provision. It doesn't matter that we prosecute 100 people and at the end of the day we are not able to get convicted even 2 or 3. It will be better to prosecute 10 people and get all those 10 convicted. So that's an idea, I believe, with which this circular has come, and that's the effect of this circular will be.
That really makes sense, right? I mean, instead of serving notices to everyone, taking all these cases under scrutiny, and then turns out that you just have 10 to 20% of SSCs that have actually been brought to book, you rather improve the quality as opposed to increasing the quantity. Again, for our viewers as well, it's not like this is something sort of a blanket easing of prosecution norms. It will be taken on a case-by-case basis, as you just heard Mr. Jain as well speak. And Mr. Jain, the other interesting case is with respect to TDS. Now, this would, of course, apply for all our viewers watching who may be having a small business. If that TDS amount that they have failed to deposit is under 25 lakh rupees, in fact, for that matter, it's noteworthy to recall a famous case, Feroz Nadiadwala, who's a Bollywood producer, hit the headlines, when in May, there was a magistrate court that sentenced him to rigorous imprisonment because he did not deposit 8.5 lakh rupees of TDS. I think that case has gotten pretty famous, or should we say infamous. So essentially over there as well, Mr. Jain, do you believe that law as well is to basically ease the life of all our small time entrepreneurs and businessmen?
I think we need to make two distinctions on this part of TDS. See, when you deduct tax on behalf of some other person and you deposit in the government, you are rendering a service to the government. But at the same time, after deducting, if you don't deposit, then it is virtually a case of a cheating. That the person whose tax you have deducted, and it is the credit which has gone to should go to that person, but you have not paid, and that's why that person can be deprived, or the state or the central government will get deprived of the taxes. So there was this debate going on, and the reason that's why the provision of the TDS were rigorous was because of this aspect only. Because you are a trustee when you deduct the money, and if you don't pay, then you are not complying with the trust which has been reposed in you. So these provisions were rigorous. But at the same time, what was happening in many of the cases, people who deducted tax but could not deposit in time for one reason or the other reason, maybe 10 days default, 15 days default, 1 month default, or 2 months default. Now those cases were also being prosecuted. Now all TDS returns are being filed on computer online, and immediately the computer was able to find out that this person was required to deposit 10,000 rupees on 7th of February, but he had deposited on 10th of February. And in many of these cases, the prosecution notice were being issued because there were no such guidelines giving concession on this aspect. So now the guidelines have been issued saying that in case TDS default is of rupees 25 lakh or less, and the period of default which we will delay is less than 60 days, then prosecution will not be launched. But at the same time, as I said, for the willful default in awaiting taxes or income, same provision is here that this concession of 25 lakh rupees will also be available only in those cases where their default is not of a recurring nature and the person is not a habitual defaulter. In case a person who has been deducting tax but he has been habitual defaulter in depositing these taxes, then probably he will not get any benefit out of this. We have a typical case of a Kingfisher Airlines where there is a lot of employees whose tax was deducted at source, but it was not deposited by the employer. So with the result that those employees are running from pillar to post to get credit of their taxes, which the employer has deducted but still has not got the benefit thereof. So that is the challenge which has come onto it. But considering the overall impact and considering the fact that there has to be some threshold, the people who are small shopkeeper, people who are running small businesses, there could have been a default of say 10 days, 15 days, an amount maybe 10,000, 15,000, 1 lakh, 2 lakh rupees. You engage some contractor, you are not able to deposit a tax of the deducted of the contractor, or you fail to deduct the tax of the such depositor. So all those issues now will get settled down with the liberalization. It is a scheme which I will say gives benefit to the small persons, people who are honest, but there are technical default for one reason or the reason or by reason beyond their control. But at the same time, it is a deterrent to those who are in the high tax bracket, where the amount is more than 25 lakh rupees and who are habitual defaulter. So that is the distinction which is being made. And I believe prosecution, imprisonment is the last resort of a penalty. So it should be resorted to in the rarest of cases, not in all cases. That is what the intention of this circular is, which has been issued by the Honorable Finance Minister.
Okay, I hope all our small business owners, etc., were paying attention. I think it was pretty valuable what Mr. Jain did say, especially with respect to the intent. Remember, the aim is not to essentially provide a blanket sort of protection of sorts to all taxpayers. It's very important to note that. Okay, Mr. Jain, the other big notice the other big rules that were notified was faceless scrutiny. What they are basically saying is that with effect from today, you do not need to go over to that Aikar Bhavan, to the income tax department. You being a CA, I'm sure you've represented a lot of clients as well. You've had a lot of income tax hearing dates, etc. So how will that work now? If I, as an assessee, have received that notice under section 143, subsection 2 or subsection 1, and they ask me to, provide documents, how will it work from there on then?
I need to appreciate this point which you have raised, and just to give you an example, when a person is accustomed to do a work manually and later on when he is asked that this same work can be done on computer, there is initially resistance, and later on once you get accustomed to work on computer, you find how easy it is to do a work on computer, etc. We have been booking ticket, airlines or railways, etc., buying something, going physically in the market or going to the station or going to the airport, and we were happy that time. But later now we feel how much comfortable we are while we do online booking of airline ticket everywhere and nothing to do. Nobody moved. In a minute or second you can book the ticket and you can get the cancel, you can get the refund. The same thing is likely to happen with the income tax department with faceless scrutiny. What has happened, we have become accustomed that income tax officer will issue a notice, we will go there, we will show document, we will explain, he will accept it, and then he will pass an order. Now what the faceless scrutiny says, same thing will happen what has been happening earlier, but only thing is the officer who is doing your scrutiny, he is not seeing your face. The officer who is doing scrutiny, you are not seeing his face. So that's the thing which is happening. And that is why it is being called a faceless scrutiny. The officer will send a notice which will not come by post, which will not come by physically by a postman or a delivery person from the income tax department. It will come in your email. Look, gentlemen, you have filed a return declaring so much income. On that return, I have these questions. Please send me answer to these questions along with the supporting documents. And all you need to do is compile those documents, make a reply, post that reply, and it will go online. And that officer who you do not know whether sitting in your city or sitting in some other city, he will look into those questions and he will look into your answers. And if he is comfortable with those questions, etc., and the reply which you have given, he will pass an order and that order will come in an email. That's a faceless. In case he is not comfortable, he will send a supplementary question to you. Look, gentlemen, you have given me this reply, but this reply is not complete. I want this information more. I want this document more. He will send the document to you, and on that basis, you will again be required to answer those questions and give further document. And in case he gets satisfied, he will complete the assessment. So I will believe over a period, as we get accustomed to this style of working, which we call a faceless scrutiny, we will realize the same thing which we now realize when we make a booking online. So it will happen a very, very comfortable position both for the tax administrators as well as the taxpayer. And in the long run, it will be everybody will appreciate that this has taken away all issues which normally arise, where personal egos, personality, all those issues go up because you do not know the assessing officer, or assessing officer does not know you. So that is, I believe, it will be a great success, and the scheme is now going to be introduced from 1st of October, and it is applicable for all those tax returns which we have filed last year. So those notice will come online, and it will be a faceless scrutiny. That will be a great thing which is happening on this aspect of the income tax, I believe.
Mr. Jain, I doubt there will be any resistance when it comes to faceless scrutiny as opposed to when it was booking tickets online, because I think many viewers do find it quite a scary ordeal to go face an income tax officer with all your documents and explain where you've got your income from. But yes, it's of course a big attempt, and I think Mr. Jain is definitely giving this one a thumbs up for sure. Okay, you know what, let's kickstart our Ask the Money show, and then I can have my follow-up question with Mr. Jain. We've already got our first caller, Mr. Vivek from Akola. Hi Vivek, thank you for calling us. What's your query?
Hello. Yeah, my query is that the first is regarding TDS.
Yes.
If a person has deducted TDS from payments made to me,
Okay.
and has defaulted on payments, then what is the recourse available to me? That is one. And the second is with regard to faceless scrutiny.
Yes.
Now it has been found that many a times the number of documents and the total volume of documents required is substantially large, and it cannot be uploaded on the system.
True.
In such case, what should I do as an SSE? Thank you very much.
All right, fair questions. And yes, we do know that India's internet speed is notoriously slow. In fact, some of us did face that problem even when filing income tax returns, LLP papers, MCA papers, etc. So it's a fair question, technical question. First up, Mr. Jain, we were talking about if the company does not pay, like what happened in Kingfisher. So what's the recourse available to Vivek? And yes, his second question, when there is volumes of documents that the income tax department will want, what will we do then?
See, let me answer the second question first. In the faceless scrutiny, the department, you see, giving a module where number of document you want to upload, there will be no restrictions. It is not that because whatever it is, the system is being created and will be available when we open in from 1st of October. So you will not have any challenge on the number of document you want to upload it. And I can share with you the experience which many of the courts are having, and including the Delhi High Court. A lot of document, including the bunch of file of 500,000 pages, get uploaded online, and there is no problem on that way. And I'm quite sure that department, when it is opening up its faceless scrutiny, there will be no restriction on the number of document which you can upload, and the system will accept it, and that should not be a challenge. As regard your second question, I believe your question is that in case some person was supposed to make payment to you and on which he had deducted tax, but he has not deposited the tax, or there is a question that he has not made the payment. If he has not made the payment to you, that's a separate question, that is a civil law. But on the point that when he had deducted tax at source, and if you have small evidence that tax has been deducted on that payment, you are entitled to claim credit of such tax paid. The law, if you look at the income tax provision, section 205, to be particular on that part, gives a right to the deductee, you being the person whose tax has been deducted, that in case tax has been deducted from your payment, you are entitled to claim credit of the same tax. And it is then there is a dispute within the tax department and that deductor to recover. And that's why when we were discussing earlier, the prosecution provisions were meant only for that purpose, because that is a cheating, that's a distrust. The person, after having deducted, not paid to the government. So it is between government and that deductor, and you will be entitled to take credit of the same.
Okay, so Vivek, it's not your problem if the person who made that payment to you after deducting TDS has not paid it to the government. That's between the government and the person, the payer, basically. Okay, we've been getting a lot of calls. Samir from Mumbai joins us now on the phone line. Hi, Samir. Good evening. What's your question? I think that was a disconnect. Yeah, we lost him. Okay, let me take the next caller. Ravi Kala from Bengaluru. Ravi, good evening. What's your query?
Good evening. My daughter, by default, by mistake, she has paid instead of 2018-19, she has typed it as 2017-18, and she's paid the ITR,
Income tax.
Income tax.
Okay.
So, how can she claim it back?
Okay, it's a tough one. There's a possibility you may have to make a fresh payment and then claim a refund. But yeah, it's a technical error essentially. Mr. Jain, she's put in the wrong year. She's punched in the wrong year when she went to make that online payment for her taxation. So what's the recourse for her?
See, frankly speaking, as on date, she doesn't have a recourse. She has to, ultimately, practical view will be she has to make the payment for the subsequent year, and for the earlier year which wrongly she has typed, she can claim a refund. Or alternatively, she should have to write to the DG system, give an undertaking, an affidavit, and in case if it is accepted, then only it can be corrected. That's the only mechanism available, otherwise there is no mechanism. Because in online payment, one has to be a little bit careful and attentive, because something going wrong, it can go to the wrong account, it can go to the wrong year, then one can run into difficulty on that aspect. So my suggestion will be, in case the amount is not very big, so all that you make the payment in subsequent year and claim the refund of that taxes. But in case there is a substantive payment, then you should talk to the DG system which is here in town, go and explain the provision, and he will take your undertaking and affidavit, and then he will be in a position to shift the credit from assessment year 17-18 to 18-19.
Okay, no option but to make the payment and then claim the refund. And with things speeding up so much, I don't think you'll have to wait very long for your refund. I mean, salaried employees nowadays with simple ITR ones and ITRs, they do tend to get their refund very fast. So if your case is simple as well, you should get your refund quickly. But yeah, for now, there is no recourse. I think that would be a faster option as opposed to writing to the DG, etc. I suppose, like Mr. Jain was suggesting as an alternative. Okay, you know what? Till we get any more callers, let's take an email query that we have received. Mr. Ranjit Sibal has written into us saying that I'm salaried and I have for the first time ever received a scrutiny notice from the income tax department. It's probably because I have sold my house in that year. Now, if the scrutiny is now going faceless, should I simply email them without appearing? The notice says I have to appear before an officer with supporting documents. So it's a very valid question essentially that Ranjit has, Mr. Jain. Does this faceless scrutiny rules apply for all cases, or is it going to be for notices issued from a particular date onwards? Mr. Jain.
As you have rightly pointed out, the faceless scrutiny is for assessment year 18-19 onward. So the return which were filed earlier, from 1st April 18 onward. Now, in the case of Mr. Ranjit, apparently this notice has been received. It may be for assessment year 17-18 for earlier years, for which now he has been asked to appear personally. But he has an option of e-assessment. Now, it is a faceless scrutiny, and earlier the scheme which was introduced last year was e-assessment. So what he can do is he can go to the portal of the income tax department, and there is a window there is a e-assessment, and there he can send a reply to the assessing officer in response to the notice he has received, and can request for e-assessment and give the reply thereon. And the assessing officer, in case he need any further document, he will send a further questionnaire through email to him. But still thereafter, in case the assessing officer believes that something more is required from him or his statement etc. is to be recorded, then he may insist upon a physical appearance before him. But looking to his case where he has sold out some house and a capital gain issue is there, I am reasonably confident that this issue will be of a e-assessment. So let me make a difference between e-assessment and a faceless scrutiny. E-assessment was introduced last year and faceless scrutiny has been introduced this year. So Mr. Ranjit can go for e-assessment. He can tick that box, send the reply, and ask the assessing officer to correspond through the email rather than calling him personally therein.
Right, Ranjit, I hope, Mr. Jain has been able to answer your question. On that note, we'll have to shut shop and ask the Money Show. If we've not been able to take your calls, please do write in to us. We will definitely take it up the next time we talk about taxation. The Money Show at etnow.tv is where you can write in to us. Mr. Jain, thank you for very patiently answering all those questions and queries from our viewers, and of course, breaking down what e-scrutiny means. And of course, what the new norms are for prosecution of tax defaulters. We'll take a quick break on the Money Show, but here's what we have lined up. A very interesting interaction with Sarah Newcomb of Morningstar, who is a behavioral finance specialist, which means she will be decoding some of the biases that you may be having when it comes to managing your money. Also, just after this very short break, we are going to be getting in a review of the LIC Tech term plan, the second plan from LIC just after the LIC Jeevan Amar was released about a month ago. Quick review on whether this one is worth the buck. Welcome back. You're watching the Money Show on ET. Now, we just had an in-depth discussion on taxation, the new rules that FM Sitharaman has brought about to make life easy for the honest taxpayer. So we give you a glimpse on what the future could look like when it comes to taxation. But here's another topic that we thought is worth exploring, and that is the second term plan launched by LIC just after they have launched their LIC Jeevan Amar scheme. It's a tech term plan, which means, as the name suggests, it is going to be available only online. Now, this is a non-linked, non-participating life insurance plan, a pure protection plan, and I think it's a simple term plan. So how exactly does it differ from the Jeevan Amar, and why exactly should you opt for it if you should opt for it in the first place? We thought, let's get you a breakdown of or a review of sorts of this new product from the stable of LIC with Anil Rego. He's the founder and CEO of Right Horizons. Anil, thank you for joining us on the Money Show today. Let's kickstart the conversation with this second term plan. Based on an initial perusal, what do you make of this tech term plan? I mean, it's been launched just, I think, a couple of weeks after Jeevan Amar was launched. So if you could just share with us some of the key features, the key advantages of this term plan.
Yes, definitely. A term plan is about, being a pure risk cover. So it's just that. To start off with, what becomes important in a term plan is what is the cost of the term plan. So most of the private sector companies have an online version. An online version basically, takes away the advisor or the agent in between and passes on the benefit to the client. So that's almost like a direct mode that the mutual funds have. So because of that, the premiums are cheaper. In the case of LIC Tech term plan, it is cheaper by about 25% over Jeevan Amar. So that's basically, the brokerage which is getting passed on to the end consumer. It must be noted that it can be only done in online mode. Okay, there are a few differences as well. The minimum sum assured for this plan is sort of increased to 50 lakh rupees. It has a higher sum assured rebate starting at 1 crore, whereas for Jeevan Amar it is starts at something like a 50 lakh of rupees. Now there is one option which I thought I must highlight, which is an interesting one, and investor can choose between a level sum assured or an increasing sum assured, and the increasing sum assured basically from the 6th to the 16th year. Okay, 15th year, it increases by 10%, and so that's a feature of an increasing sum assured over a period of time. But broadly, it's definitely a plan to consider because LIC was not as competitive on the term plans. A lot of the private sector guys were, very competitive. I think there might be still some way to go, but at least LIC is trying to now come back and gain some market share on the term plans for people who like LIC as a brand name, okay, and want the safety of the government, okay, then I think the LIC Tech term plan is one to consider.
Okay, one to consider. So Anil Rego approves of the LIC Tech term plan. Anil, just a follow-up question. You mentioned that investors or other, basically people who want to buy the term plan do have an option to consider between level sum assured and increasing sum assured. And I think a lot of plans nowadays seem to be opting for that increasing sum assured. It's almost like gone are the days when there was only a level sum assured. So if you could explain to our viewers that why they should pick the increasing sum assured, or what are the benefits essentially compared to level sum assured?
Yes. So especially if somebody is, in their prime working age and, has more years to go, then, as time goes by, your income, etc., is going up and possibly your standard of living. So it makes sense to, look at an increasing sum assured as a feature. Now, the other feature that I think people can also consider is you have a choice between, in case of a life risk, getting it lump sum or getting it for over a period of time in installments. Okay, so now the period of time over installments may be an interesting one, because what happens is the family sometimes gets the lump sum and they don't know how to reinvest. Somebody misuses it, misleads them, etc. They have a problem. So you can choose to have it over a tenure of 5, 10, 15 years, and you'll get a sort of a yearly installment scheme as well. And I think that's the second feature which you can consider versus a vanilla term plan.
Okay, there is this one pointer that some viewers as well, in fact, sent in a question to us about when we did talk about discussing this plan, and that is with respect to essentially the fact that there are no surrender benefits or maturity benefits. Basically, the term insurance plan sum assured is paid only in case of death. Do you believe that would perhaps be a drawback when it comes to selecting this term plan?
Actually, no, because if there's also return part of it, then obviously your premium will not be the same, right? So in the end, you're just combining investment as well as term, right? So I think it's good to have an option of only term. If you want something with return as well, then I think there are enough and more of plans to consider that all the insurance companies have. But I mean, this is the important part of it, that you have it at a very low cost, okay, and it becomes affordable, and you cover yourself and take care of the risk itself. You can also have the option of investing your money elsewhere rather than giving it to the insurance company and tying yourself to it.
Question at least. Okay.
Yes.
Just Anil, to reiterate, the main thing that when many of our viewers do consider when buying a term plan or an insurance plan is basically the premium, what they'll have to pay right now. Sum assured jab milega tab milega, but what is the outgo that I'll have to pay right now, right? So you mentioned that the LIC Tech term plan's premium amount is a little lower. Would 25%. That... So what exactly is the difference we are talking about? And I mean, how is it even if you pitch it against other private insurers?
Yeah, it's 5% lower. So it's a very handsome difference, okay, versus the LIC plan itself. Versus the other life private companies, there are companies which may be cheaper than this particular plan.
Fair enough. Anil, you brought about a very important question when I spoke to you earlier, and that is, what is the basis for a person to decide on what is the life cover they should take? So Anil, if you could throw some perspective on that as well, because when you do take a term plan, that's essentially what you are doing, right? Okay, no, we've actually lost Anil Rego's, we've lost that line with Anil Rego. But, just to summarize the entire conversation I had with him earlier, yes, it is another term plan from LIC stable. It's a tech term plan, and it's launched just a month after, the LIC Jeevan Amar plan has been launched. So it may be a little confusing as to why LIC has launched 2 plans in just 1 month. But basically, it is essentially a plan that's available only online. Minimum age of entry is 18, and you cannot take it beyond 65. Also, the minimum sum assured has to be 25 lakh rupees. So if you want something below that, this is not the plan for you. And roughly it will come to around 9,000 rupees or in terms of a premium. If you take a very, very simple back of the envelope calculation, your premium amount, that is no maximum limit, and the tenure is 10 to 40 years. Increasing sum assured and level sum assured as well is a point that Anil did raise. He essentially said that increasing sum assured is the way to go. Our viewers should opt for an increasing sum assured, because it means that at the time of the death, sum assured will be higher as opposed to a fixed sum assured. When the sum assured money does remain the same. There is the whole premium payment flexibility. You can opt for premium payment monthly, quarterly, yearly, as per your convenience. And there is, of course, like I said, that sum assured flexibility as well. Also, they do not offer accident benefits or premature benefits. That's a very important point as well to watch out for. Okay, on that note, we'll take a very quick break right here on the show. But when we come back, we are going to be having that exclusive interaction with Sarah Newcomb from Morningstar to understand and analyze some of the most basic biases that all individuals like you and me suffer when it comes to your money, and it becomes a problem when it is hindering and coming in the way of creating wealth for you. So we will talk to Sarah Newcomb on how we can overcome all of those personal finance and money related biases just after this very short break. Hi everyone, welcome back. You're watching The Money Show on ET Now. We've got a very interesting conversation lined up. Did you know that almost every individual, you and me, have certain biases that do tend to affect the way we perceive the world, and that includes even the all-important topic of money. And that's when it becomes a problem, when your biases tend to get in the way of you earning wealth, maximizing your returns. And hence, we decided it was important to bring on board a very important guest who's done extensive research on this topic. Sarah Newcomb, she is a behavioral economist with Morningstar, and she's joining us, in fact, on the sidelines of the Morningstar conference. Sarah, it's a pleasure having you with us on Money Show. Thank you so much for joining us. Apart from biases and personal finance, behavioral traits, there's another very interesting topic that you have spoken about in your conference, and that is the importance of financial health. What exactly do you mean when you say financial health, and how important are behavioral finances?
Well, I think that behavioral finance has grown in its value over time, or at least in people's recognition of its value, as we see that our predictions of what people will do and what people actually do are quite different from one another. And this is where psychology becomes important, because our financial decisions are deeply rooted in our emotions and our psyche. And we can't divorce the fact that what happens to our money happens to us. And so when it comes to making financial decisions, financial health turns out to be a lot more than just having a lot of money. You can have plenty of money and still not sleep at night. But financial health is a combination of having economic security and having the ability to enjoy that economic security.
You have a lot of money, but you can't sleep at night. Like they say, money can't buy happiness, hence financial health. So Sarah, how should investors then consciously pay attention to their behavior in the market and sort of overcome all of these biases, or improve their chances at least of making money in the market?
It may sound overly simple, but our studies show that what's more important than market behavior is your behavior as an investor, and specifically saving. The biggest thing that makes a difference is contributing to your investment accounts. The market can go up 300%, but if you haven't contributed, you don't take advantage of that gain. So the biggest behavior to watch for is actually saving.
So what are the most common biases then, Sarah, an investor suffers from, especially us in India? What is the most common bias?
Some common biases that you may have already heard of are overconfidence. That's a big one. We all think that we're better than everyone else at playing the market. And the market is fun. But another bias would be present bias. And present bias is probably the most pervasive thing. Again, present bias keeps us from saving in the first place, because what happens is that in our mind's eye, the here and now are so much larger than the far off vague future that we're saving and investing for. And because of that, our mental cost benefit analysis gets skewed. And so we value the present more than we value the future, which means that a lot of us would prefer to spend in the present than we would to invest for the future. And so we have to do something to counter the effect of that bias.
Okay, so let's delve more into some of these biases. I'm sure when a trader is playing the market, is trading in the market, his biases will be different as opposed to, an individual investor who may be having another business or maybe salaried and is just investing via mutual funds. How do the biases of these two individuals differ?
So I think that when it comes to mutual funds, there is a tendency to treat them as if they were stocks and to trade them when new information comes available. But when you invest according to a mutual fund strategy, you've looked at the long haul and you're investing for the long term. And so this new information should be irrelevant to your investment plan because it was thought of before you invested in the first place. And so it's not a specific behavioral bias so much as it is just a tendency to treat any investment as if it were a stock.
Okay, I want to ask you specifically from an India perspective, Sarah, for Indians, what's your observation on the biases found? I mean, you mentioned overconfidence, perhaps too much risk aversion. What is it that Indians tend to suffer from then?
From what I've seen and heard in India, which is limited, of course, is a tendency to overvalue gold and real estate above any other kind of investment option. And gold and real estate are fantastic investment options, but they are only two, and there are many more. And in order to truly diversify your portfolio, you want to expand beyond that. So I would say it's a risk aversion, a type of risk aversion that manifests itself in only holding physical assets.
All right, and Sarah, of course, I must ask you this question then, and especially for all our viewers out there who are women who leave all the money matters to the men. Sarah, men or women, who can be better investors?
Well, this is a tricky question because most of the research does show that women tend to be better long-term investors. But I tend to think that human nature is human nature, and fear and desire don't limit themselves to one gender or the other. So we should all be aware of which of those forces is the most powerful in our own lives.
Okay, Sarah, it was a pleasure having you with us. Thank you so much for joining us on The Money Show on this very interesting conversation. It's important to understand the biases that you suffer from because it may be coming in the way of making you wealthy. On that note, we'll wrap it up on this edition of The Money Show. Thank you so much for watching.